So I have 4,000 on gold. I can't remember whether when we talked last time I was there, I had been at 3,400 and
Mm.
raised it sometime in last year. So I raised it to 4,000, and I think we've been consolidating since April in a sideways consolidation. We're very close to breaking out of that, and I think we're about to. I think we'll see it in September, um, and have another nice run, probably to 4,000 in the last 4 months of the year. Um, Silver, I have a 75 target that I've had for a long time.
My guest this week on GoldCore TV is a gentleman who describes himself as a contrarian macro investor, and he is no stranger to having his calls derided and mocked online. Calls such as the Dow getting to 45,000, and yet where we are. The S&P to 6,500, yet here we are. The man himself, Mr. David Hunter, welcome back to the channel.
Yeah, hi Dave, great to see you.
Likewise, likewise. I always really enjoy our conversations. Now, those are a few of the calls that you talked about before, and as I said, you do get a hard time online,
Yeah,
particularly on X for your calls.
yeah,
Uh,
comes with the territory. It
it
looks crazy when you make the call, and then as it works out, uh, they kind of come and maybe slightly apologize, but then deride me for the next things.
exactly. You must be feeling a little bit smug, we should say, at this moment in time. Um, you've been fairly accurate, and you have made some what seemed at the time some very wild calls, and they have come to pass. Now, you've actually reviewed those calls, revised them, and you think that the extent to which markets could get extended is even greater than you previously considered. Before we dive into that, um, what are your big calls at the moment, and then we'll dive into exactly what's driving that.
Yeah, so I have raised targets on all my market indexes. So in my last letter back in July, I raised my S&P target to 8,700. So I mean, I think there may be 7,000 targets out there, but they just recently brought their targets up there. Most people were in the 64 to 6,600 area, and some not even there. And as you know, last April they all thought the bottom was going to fall out of the market. So I actually raised my target to 8,000 back in April at the bottom. When everybody was getting more negative, I was getting more, in my contrary way, more positive. The sentiment had gotten so negative. And then when I took a look in July, my analysis just said you're not high enough. So I raised it to 8,700. My NASDAQ target I raised to 30,000 from 27,000, which had been raised back in April. And then I raised my Dow target to 60,000 and my Russell target, which was pretty extreme already at 3,300. I raised another 100 to 3,400. Um, People think I'm a moving target. No, it's just when the analysis suggests that I'm still too conservative, I'll raise my numbers. So they do seem extreme at the time that I put them out, but I'm looking forward, not backward.
Okay, I'm going to be a bit cheeky here and say, are you a contrarian for the sake of contrarian, or do you just want to have the highest target that's out there in the market to draw attention to yourself, or what really backs up your calls?
Yeah, I'm not that at all. I have said many times, I'm the first one to tell you my forecasts are extreme. They're extreme because that's where we are in the super cycle, or that's where we are at the end of a 43-year secular bull market when things do go to extremes. So it may look like I'm just trying to draw attention, but that's not at all the thing. And that's why I actually don't don't go to where I end up initially, because even for me, I can't go that extreme. So even if I think things are going to be higher, I go to where I think I'm making a reasonable bet. And then as the time goes on and analysis suggests I should, then I'll raise some more. But I'm already so far outside everyone else. Whether it was back at 6,000 or 6,500 or 7,000, that it, even I try to temper what I actually think it could go to. So but I am, in fairness, I am trying to sincerely put out what I think is going to happen. I'm not trying to play games. I'm not trying to get more eyeballs or attention. It really is. I'm a contrarian because I understand sentiment, and I've spent 52 years studying it. And at turning points, I'm very contrary. At times like this, where everybody's starting to jump on board, I'm not so contrary. I mean, I'm contrary in my numbers, but people are getting more bullish, and that doesn't mean I get bearish.
Yeah, and there are a lot of people that are making bullish calls out there, but yours are on the extreme end. So
Right.
the question to you then is, what are you seeing that other people are missing then that makes your calls so much more bullish in most instances than other analysts?
Yeah, like I said, I'm driven by sentiment. I use fundamental analysis, technical analysis. I put a lot of pride in my macro. I think I'm as good a macro analyst as there is out there. I've been doing it for a long time. I think I'm as good a contrarian as there is out there. I'm not afraid to be away from the crowd. So I think a lot of times the numbers kind of congregate around a mean
Mm,
because I don't think people are comfortable going too far away from the crowd.
mm.
And that doesn't bother me at all. I'm most comfortable when nobody agrees with me. So that's part of it. But I mean, it really does come down to what I see out there, and it's come from 50 plus years of doing this. I mean, I've called cycles over time, and I'm not trying to be different than everybody else. I get when everybody starts sounding like me, people wonder, they go, "You're not really contrarian." I said, "Well, there are lots of times I'm not. I'm not. I'm just going to go with what I see in my analysis."
Let's talk about the stock market then, just as an equity or as an asset class rather at the moment. There's been some interesting moves in the stock markets this year, and as you pointed out, back in April we did see what we thought was going to be a much deeper bear market correction, but here we are again now touching on all-time highs. Your call for the Dow is significantly higher than where it is now. What's underpinning that? How?
How do we get there?
Yeah.
So I think what we're going to see, and it's starting to happen, as I've said for a long time, from basically 2022 up, from October 22 bottom down at 3,500 on the S&P, and I don't remember where the Dow was, but from that point forward up until very recently, and even now, most of Wall Street was skeptical. Retail did better in April. They didn't fall for the head fake, and they stayed bullish and they bought generally. So a lot of retail got scared, but generally the retail did better. Institutions got bearish, and they've been skeptical of this market all the way up. They keep looking at valuations and thinking valuations are at peak levels and they can't go much higher, and et cetera. What we're seeing is obviously because of AI, but also other things, the companies have done a great job in an environment that wasn't that easy to keep pushing the earnings higher. And, I saw that. That was part of my thesis. I also think people are way too bearish on the bond market, on interest rates. And I think, in fact, I'm very bullish on bonds and think rates are going to go a lot lower. And that's different from, I think, the street.
On the short end or on the long end? I mean, we're obviously
Both.
we've
Both.
obviously seen the last couple of weeks, particularly with Powell's speech at Jackson Hole, we've seen that there's kind of a bit of a capitulation in the Fed, and it looks like the White House is going to have more significant influence over the short end of the yield curve. So we are likely to see cuts where we weren't necessarily pricing them into that extent previous. So that bring the short end of the curve lower. But the long end of the curve, particularly, and it's not just the US bond market, but we're seeing this across the globe, the long end of the bond markets, the yields are going significantly higher. Do you think that's extreme overdone and will reverse?
Well, I'll speak to the U.S. You guys over in the UK are dealing with something different, and I don't follow close enough to know. I commented yesterday, and somebody joked there wasn't much analysis. I said I can't really analyze because I don't follow it. But my view is, I said it was probably inflation's probably ticking up there among other things. But you guys came down before us, and so you have, I think you're trying to sort of catch back up to where we are to some extent. And I think probably, we're not in sync in terms of our economic fundamentals exactly. So, but ultimately, I do think the U.S.'s rates are headed lower, both on the short end and the long end. I am very much and have been consistently saying, though today's GDP, for example, came out with a revision upward, 3.3% on GDP for the second quarter, I still believe under the surface we have an economy that's not doing that great.
Mm.
And we have an economy that's heading for recession. So that has kept me bullish on bonds. I'm not so worried about exactly when it turns or how much it turns initially or whatever. I do think you're going to see the 10-year go to 3%, maybe by the end of this year. It doesn't have to be by the end of this year, but maybe. And ultimately, next year is going to be a rough economy, in my opinion. I call it a global bust. And in that, I think you can see the 10-year all the way down to zero. So I'm contrary
Mm.
to say the least. But I am not in the camp. I know there are a lot of people that look at last fall and say, oh, the Fed can lower rates, can cut rates, but the long end is going to go up. And I know that's a big story around Wall Street. I don't believe that at all. I think you've seen, basically, I'm more focused on the 10-year because that's what loans get priced off of, mortgages get priced off of. But even the 30-year will ultimately fall. It may be stickier to come down initially, but ultimately, I think all rates across the curve are going to come down. And even the corporate bond market for at least a little while longer is going to do okay.
Your calls, particularly on the stocks, are relatively short term. We're talking some of these by the end of the year. You're looking for significantly higher. That's quite a short term horizon, is it?
Yeah, so part of my thesis has been that we're in the end game of a 43-year secular bull market. At one time, I thought it was going to be a second 42-year, and it stretched out. But it started in August of 1982, and the Dow at that time was, I can remember because I was running money then, and I turned bullish in August of 1982 in a new place where I basically had a great run. And they fought me. They were not equity guys. They thought we were crazy to do what we did, but I had top percentile numbers for 5 years running. The Dow back then was 780,
Wow.
780, and I'm calling 60,000 for this year. And frankly, I get beat up, as you know, all the time about moving my time targets. I don't have a time target per se.
Hmm.
I do. I'm not saying it can happen anytime, but whether it happens in October or November, December or January, I don't care. It's coming soon. Um, and people say, "Oh, you've already pushed it out again." No, I haven't. I haven't changed anything. I still think it could happen, by October or November. But anyway, it's rates coming down and earnings going up, still holding firm. And very big part of this, and the dollar selling off, and a very big part of this is Wall Street moving from constantly looking for a top with one foot out the door to being all in. They're getting closer to capitulating here and saying, yeah, I got to get more bullish because this thing has legs. And that's going to be the fuel for what I think will be a very steep run. But in answer to your question of how you could go that far that fast, it's a parabolic that I think comes at the end of such a long cycle.
Right.
Um,
And that kind of parabolic spike at the end is also as a result of that kind of confluence of factors, earnings higher, yields lower, reduction in the value of the dollar. That's kind of, I think, a theme that underpins a lot of your calls as well, which is a reduction in the reduction in the value of the dollar. So
mhm.
effectively, it's not necessarily just the value of stocks going up; it's actually just the value of the dollar going down. It's inflation in another
Right.
guise, effectively.
Yeah,
You're,
asset inflation, because I believe
yeah.
we were heading towards deflation. I'm not in the inflation camp, but asset inflation for sure because the dollar's going down. And probably the easiest place to look at that is in the metals, right? If you look at
Mm.
gold, most of the
Nice
move,
segue into the metals there, Dave.
yeah. Well, yeah, I wasn't trying to jump ahead of you, but if you look at gold, for example, whether it be in dollar terms or other currencies, a lot of the move is the inverse of the currency, right? So we're
Indeed.
we're in a dollar decline period, and that's very bullish for gold
Indeed
for
it is.
in dollar terms.
And just in dollar terms, then, what are your precious metals calls?
Yeah, so I have 4,000 on gold. I can't remember whether when we talked last time I was there, I had been at 3,400 and
Mm,
raised it sometime in last year. So I raised it to 4,000, and I think we've been consolidating since April in a sideways consolidation. We're very close to breaking out of that, and I think we're about to. I think we'll see it in September, um, and have another nice run, probably to 4,000 in the last 4 months of the year. Um, Silver, I have a 75 target that I've had for a long time. We're right now, as we speak today, I think, at the highest level silver's been at since 2011.
that's right. Yeah.
So that's a big run. People have been very skeptical of silver, and it's awakening. I think next stop is mid 40s, and then from there, I think it's 75, and you could be there by the end of the year. Like I said, as I say on X all the time, markets don't care about the calendar. So whether it's December, whether it's January, it's sometime in a time frame that's not too far out.
You make a lot of our subscribers and our clients very happy. We get to 75 by the end of this year on silver for sure. And you're talking about those calls, 75 and ultimately 500 on silver, and then the 4,000 again potentially by the end of the year on gold, underpinned by the same fundamental thesis as what you're talking about for the asset inflation in equities as well.
Yeah, that was one thing that people didn't. I think I was relatively contrary on this. Was people have been conditioned to think that gold moves inverse to the equity markets, and I've been consistently saying that's not necessarily the case. That in this environment that we're going to have with lower rates and lower dollar, both equities and the metals will move up together, and surprisingly so, bonds as well. So
That was going to be my next question because I'll get hauled up in the comments if I don't ask you. I mean, that's a kind of call on itself where you're talking about seeing higher equities, higher bonds, and higher metals,
yep,
which is really probably only possible with a flight out of the dollar, flight out of fiat currency in general, and just looking for any sort of a home at that stage. Is that what you're
It's
talking about?
it's that it's that, and also if you look, and I guess I cut my teeth in this. Like I said, I my favorite time to remember was 1982 because I hit it right on a dime and had really top 1 percentile pension fund manager performance for 5 years running in a shop that I had to drag along kicking and screaming. So I remember that very well. It's also reminiscent of what you get at when you have the start of a Fed easing cycle,
Mm.
right? So when the Fed starts printing, what moves? Rates move down, so bond moves up, equities move up, and metals move up. And so that's what it's going to feel like, I think, in the next 3 or 4 months. The thing is, we're not starting from a trough.
Sure.
We didn't go through a bear market. So that's what's unusual, and I think that's where people are going to probably get it wrong. Is they fought this all the way up. I keep saying that at the top, what you'll see is everybody will be all in and tell you this thing has years to run, at least a couple of years to run, and I'll be at that point contrary and saying no, this is the top. We're close to the top.
And you think we move into a deflationary cycle after that? Is that a kind of a general CPI deflation? Are you talking an asset price deflation or?
More than good question. More than asset deflation, I think we will actually see CPI negative, PPI negative, even PCE negative, and it comes. My reasoning is pretty simple. It's number one, we're highly leveraged. The reason I call for a global bust is because we're so far beyond even 2008-9 in terms of leverage on the system, both debt, as I keep quoting, 330 trillion in global
Mm,
debt, and I realize a lot of it's sovereign, but 330 trillion in global debt, and quadrillions in notional value of derivatives. Never been here before, never. And derivatives are leverage on markets. Debt is leverage on the system. Um, Never been here before. I mean, this is so far beyond anything we've charted in our past. That'll turn a normal downturn into something far worse, I think. And so, and obviously a financial crisis if leverage starts unwinding. Um, so that's how I get to a global bust. And
And the timing of that, like, are we talking, I know you don't like to necessarily mark a day on the calendar, but the timing of that, is it a case of after we see the parabolic spike, that's when we move into it, and that parabolic spike in itself is a potential movable feast, depending upon what's happening on a macroeconomic perspective?
Yeah, the bust, will probably be, you have to go through recession before you get to bust, right? So
Mm,
you start the downturn in a recession, and then it just accelerates
just
from there
accelerates to
into
the
something
downside.
worse. I've been saying we could be in recession already when they go back and backdate it. That sounds crazy when you get a GDP revised to 3.3%, right? You say, no, you're wrong. But it's surprising when the NBER goes back after the fact and dates recessions, it almost always starts before we ever thought we were in recession. So,
Sure.
and certainly there's a have and have not economy. So for sure, half the economy's in recession. Even manufacturing has been struggling, and half the consumers, barely get enough to eat and have enough money to service their needs. So we are, if we're not in recession, we're moving towards one pretty soon,
Mm.
and then I would guess we could see bust. I've been saying we could see it by the end of the year. That'd be awfully fast. And again, people, at least some of the retail people, think bust, and they think it all is something that happens in 2 days.
Mm.
It has to start somewhere, so it could start by the end of the year or in the first quarter. The to all of 2026, if I'm right, is going to be a bust. I mean, and it could carry into early 2027. It'll be fast, relatively fast, kind of like 2008-9 in terms of a downturn. It's not a depression, but it'll feel like a depression. It'll be something worse than a normal recession.
Okay, so it could last a couple of years. You don't see it as a
Well,
longer term
I
depression.
say 12 to 18 months, and I say my guess is the bear market, the stock bear market, will be 8 to 10 months.
Mm.
It could stretch beyond that, but something like that.
Okay.
And then by mid 2027, we should be coming out of it. The stock market may have come out of it before the end of 26, and then you've got to deal with you for a year or two, because and it's going to, the reason you come out of it, and the reason I can confidently talk about the other side, even though it's something we haven't seen in 90 years. A bust is not something we've seen in the post World War II era.
Mm.
um, but I can confidently talk about a recovery and what the recovery will look like, because I think it's inevitable that they will have to print money like they've never printed before to pull us out of this. So I've talked about a $20 trillion QE out of the Fed, proportionally similar out of every central bank because it's global. And that then jump starts with a lag, a recovery that, because of all that money, ultimately turns into the biggest inflation cycle we've had, bigger than the early 80s. And you could see,
Does that go straight back into the same assets, or are people more selective at that stage?
yeah, good question. I think, as I've seen through every cycle in my 52 years, every cycle is different leadership. So, you had the energy and the commodities in the 70s. You had housing and things like that. And basically in the 80s, it was consumer growth stocks,
Mm.
the Philip Morrises and the things that were steady growers because rates were coming down, inflation was coming down. In the 90s, it was tech. In the 2000s, it was housing and finance. In the 2000, the post 2008-9, it's been tech and healthcare and things like that. Not so much healthcare anymore. But the next cycle will be commodity driven, industrials and commodities, for a number of reasons. Reshoring will be part of it. Um, the need for, we are going to blow demand through the roof for commodities, and we don't have the supply. So there'll be a lot of machinery that'll have to be built to help build more mines, to help look for more oil. You're going to have a capital goods, commodity driven cycle. It doesn't mean you won't have AI. It doesn't mean you won't have specific areas in tech that could be winners, but it does mean they won't have the wind at their back of lower interest rates, because rates, I think, will go from zero in the bust to potentially 20% plus by the early 2030s.
Right.
So you don't, after 2026, don't think you want to own a bond.
Yeah.
As I say, if you need a fixed income component of your portfolio after 26, you will want to be rolling treasury bills or be in a money market where you get the instant increases in rates.
That's an extreme roller coaster that you're describing there, and particularly longer end. You're talking about a significantly inflationary environment. You must have some rather large calls then on the metals long term.
Yeah, I do. I think gold can get to 20,000 by the early 2030s, and I say early 2030s. That does not mean 2030. It means could be 2032 or three. I don't know.
Yeah.
But 20,000 for gold and 500 for silver. And again, just like my equity calls, I may be conservative. I don't know.
Yeah, but those long-term calls, then, if you're talking about a massive inflationary environment, you might be, you might be talking 500 for silver, but a pint of milk costs you $10.
Right,
Is
right.
that what we're talking about
By the
here?
way, the other big one is I think, and I've been probably the bear on oil since 2022, and correctly so. I turned bearish on oil before we had the spike up during the Russian invasion of
Mm,
Ukraine, but I stayed with it at 130 and said we're going back to 85. And then once we broke 100, I said we're going to 60. So I've been pretty bearish on oil. I think we see probably 30 in the bust. And then from there, and it could certainly go lower given what happened last cycle, if you remember when it went
went
to
negative.
negative.
Who
But
knew?
I'll say 30. And from there, I think you could see $500 oil by the early 2030s.
Wow.
So again, as I say, it's a commodity cycle.
Yeah.
Copper could be 20 or more. It could fall to $1 or $2 in the bust, but go from there to 20. Natural gas might be $50. I mean, I don't know where these things are going to go. What we're going to have is massive demand for commodities because they're going to be needed for building new plants and equipment and all that. Because of that 20 trillion print and probably 50 trillion worldwide, it's gonna goose demand, and we've rationalized down supply, the mining and all that, and search for oil, et cetera. We've rationalized that all down in a period when they were trying to discourage all of that. So if we get that through the roof, like I said, the demand because of the money print can happen within 1, 2, 3 years,
Mm.
whereas the having to build new supply can take 10 or 20 years. So you're going to have a case where you have supply far exceeding demand, and the only thing that can give is price.
And what you're really looking at here is you're talking about central banks and administrations just going back to the same tools that they always have, which is money printing. It's money printing that's getting them into this problem at the moment. We've got debt at $37 trillion in the US, and global debt over 300 trillion. And that it's when we start to feel a bit of pressure on the system, we're going to see more money printing. It's ultimately we'll have a bust because it's unsustainable, but then the route out of that bust is even further money printing, and you think that they can add another 50 trillion to
Globally, yep.
globally. It's just going to be what you're really calling for there is a destruction of the purchasing power of fiat currency globally.
And what I say is I'm not endorsing this policy because it's a disaster ultimately.
Yeah.
I'm saying it's inevitable. What it really is the result of is 80 or 90 years of and somebody I said, I don't know, it's sine waves or what. Somebody said it's a buggy whip pattern you're calling for, that each successive cycle coming out of the Great Depression, you had greater excesses up, greater excesses as they tightened down to combat inflation or what have you, and then that took greater excesses back up. And what we've done is successively cycle to cycle, particularly these last few cycles, is gone to much bigger extremes. That's part of what my parabolic's about, and that you're basically at the end game. The difference between myself and the Austrian camp or the Peter Schiff camp, those guys that say we're down for the count now, I say no because they have the printing press for one more time. Because we'll be in deflation, they have infinite ability to print.
Mm.
They are not wanting to print. Powell is very, very sincere when he says, I'm not going back there. I'm not doing what we did last cycle. And that's part of why we're going to get to what I'm talking about, because they're going to drag their feet while they need to be printing. They're going to be holding back, or they're not going to be printing nearly enough, or not recognizing the risks. And then they're going to have to come in 2 and 3 times what they expected, and then 4 and 5 times what they expected, because nothing's working. There's no other tool to stop a free falling financial system. You can't go to Congress and say, can you guys come up with something? It'll take them months to agree on anything. And meanwhile, the system's falling down day by day. So the only thing that can be moved quickly is money. And it will take them many months, even if they won't agree that now we have to print money. They don't understand. They don't have any idea of the amount of money it's going to take to stabilize the system. So that means it's going to be all trial and error, month by month by month, week by week by week, trying to get to a right size policy. During that time, the things are going to continue to be falling. There'll be bear market rallies. There'll be a period where market will think maybe you did it, and it'll rally, and then look and realize, no, there's trouble ahead, and down it goes again. So there'll be probably be 2 or 3 legs to the bear market, but people, particularly retail, but I think an awful lot of people think in terms of you either tighten or you ease. There's a whole lot of nuance in between that. How much do you tighten? How much do you ease? And we're going to be in something that it's uncharted waters. We'll have never been in something like this. I mean, 2008-9 kind of prepared us, but they're fighting that. They're saying they still don't understand what's coming and what it's going to require.
So the longer that they delay the medicine, more medicine that they're going to require, and then ultimately the
Exactly.
medicine is going to kill the patient.
Yeah. So exactly what I say is, by the time we get to the mid 2030s, you will have, and well before that, you will have lost the printing press. The thing that has kept these cycles going is we've had a printing press, right? When you overshot on the downside, you always had the printing press to pull you back out. The problem is that probably by 28 or 9 or 30, the inflation is going to be high enough, meaning double digits, high single digits initially, and then double digits, that you can't print money because it just pours more gasoline on the fire.
Mhm.
So you then shut down the printing press. The printing press is no longer an option, and it's at that point you realize we've lived way beyond our means. We've created a problem that we can't solve. There's no equation. Well before double-digit interest rates, we're going to have a hard time servicing our debt. We can't service it at 5%. How are we going to service it at 8 or 9%? How are we at all going to service it at 15%? So there's coming a day of reckoning where we realize we don't, our servicing of the debt is eating up the entire budget. We don't have money for welfare. We don't have money for our Social Security. Well, they have their own trust funds, so there may be some, but we don't have money to supplement that. We don't have money for military. We don't have money for other discretionary items. Um, and so long before we really get to D-Day, we'll be seeing that. They'll pull out every trick in the book to try to keep it going. But ultimately, by the 2030s, and again, I'm focused on the U.S., but I think this is a global story. And by the mid 2030s, I believe we'll see a collapse of the system we've known for the last 90 or 100 years, and basically a depression. Unlike the bus that has printing press to pull us back out, a depression doesn't, and it's going to be a much longer, drawn out period of who knows what.
Give us something hopeful to finish with, David.
Yeah, the thing I say is, you've got, if you follow this scenario, you've got basically a few steps you can take to at least make you in a better stead than most people, and that is, don't get caught up in the end game here when this thing gets very ebullient. Because if we're at 8,700 or 9,000, wherever we are, I can promise you everybody on Wall Street is going to be ebullient and telling you why this thing has legs.
Mm.
And your own psyche, not you, but the retail investor's own psyche is going to be bullish. They're going to be, it'll be the vast majority of people on both retail and institutional will be caught up in this. If you can fight that and get defensive and look and not listen to, because the other problem we have is the financial industry, the consulting industry, have rightly made the case since the mid 80s that it's timing the market, not timing the market, right?
Indeed.
That's still going to be the mantra at the top here. If you can go against that and understand that was absolutely the right advice for the last 40 years, but it's wrong advice now because we're about to see an 80% bear market, and most assets go down. If you can understand, you're not going to get it precisely, but if you can get out on this side of the mountain and protect yourself, you'll have the wherewithal to then take advantage of the commodity cycle that follows. If you don't, if you say I'm a buy and holder, markets always go to new highs. I can't time it. I'm just going to stay put. The chances are you're going to go down, and the market could go down 80%. So that means your portfolio could go down 50, 60, 70% or more. And then you got to climb out of that hole. And that's a lot of climbing to do before you just get back to even, if you ever do. So it's, again, it's contrary, opinion, but I do believe that we are at a place where timing the market will make sense. And I'm not saying now because if you do the math, I'm saying we're, somewhere between 30 and 50% from the top here, even though I think it can happen in the next 3, 4, 6 months. That's 2 and 3 years worth of returns. Mm-hmm. So I caution people, if you say, well, I'm not smart enough to call a top and I'm nervous, I'm getting out, just know yourself, because as this thing moves up another 30% or more, you're going to say, damn, I missed it. I got to get back in. Everybody's telling me this thing's going on for another year or two. And you're going to get in at the top and then suffer. So you got out rightfully on this side of the mountain and got back in and suffered. So stay put if you can for a little while, because it's going to be exciting here for a few months.
David Hunter, Contrarian macro strategist. Thanks for joining us on the channel today.
Thanks, Dave.